Hi, my name is Joseph Beige, and I'd like to welcome you to today's program. If you're a new viewer, let me explain a little bit about what we do. With the help of a guest, we're going to discuss a topic that would be related to you, the Long Island real estate consumer, with the goal being very simple. The idea is to help you become a little more comfortable and give you a little more information so you can make a better, more informed decision on your next real estate transaction. And as always, our returning viewers, I want to thank you for all your support. Thank you for the suggestions for future programs. And if you guys are watching this and you like it, please do me a favor. Hit the subscribe button and also hit the like button. That lets the Google algorithm know that this is a program that may be valuable to other people and it may be easier for them to find it as well. Now, we're filming this one today, actually on February 1st, which means January just ended. And January means two things to me. First, it means all those holiday credit card bills are coming due. The second is your mail starts being filled with the alphabet soup of forms coming or related to the IRS. W-2s, 1099s, and everything about that. That's because we're now heading into tax season, and people have to file for their personal income tax. Now, if you did a real estate transaction, either as a buyer, or seller, or even if you refinanced in the last year, that transaction may have an effect on your personal income tax, good or bad. To discuss that today, I'm joined with David Korcz, who's an Islandia CPA, and we're going to be discussing how real estate transactions affect your personal income tax. David, thank you for joining us today. Before we start, tell the viewers a little bit about your background as a CPA.
Got out of college in 1987, worked for 3 large regional CPA firms in the Albany area. 1995, the job market for CPAs in the Albany area dried up and was looking to get back a little bit closer to family, as I'm originally from Brooklyn. Moved out here to Islandia, took a position outside of public accounting as number 2 guy in finance for a large privately held beer distributor. Then I was a controller or a CFO for 19 years, so I guess you could say I'm a recovering CFO. But I got my CPA license in 1989, and I started doing tax returns as a side hustle back then. Even though I was working for a firm, I was doing work on the side. And as a CFO, I was doing work on the side. The practice kept growing and growing and growing. The last company I was with was private equity backed, and they replaced the entire management team in 2014. So I was at a career crossroads. 47 years old at the time. Do I go make another family successful by being their CFO, or I've been developing this tax practice for almost 30 years. Let's take it and give a shot at it. And so we rolled the dice, went into business for ourselves in 2014, and hung out a shingle full time, and it's been phenomenal. And
as I said, you are located in Islandia, so you're central to Long Island.
Yeah, about 3 blocks off the expressway.
First, before we get into anything, let me be clear about something. We're not giving tax advice. Myself or David today are not telling you how to file your taxes or what decisions to make. You should be consulting with a professional. The idea here today will be to raise some issues and tell you about some of the things that may be available to you, some pitfalls to watch out for, so that when you deal with your professional, you know what issues to raise and what to bring up. Having said that, David, let's start talking about the purchaser side first.
Sure.
Typical, somebody buys a home, they take out a loan for it, they closed on that loan. What are some of the tax ramifications that they need to be concerned about?
Well, since Tax Reform Act of 17, where they increased the standard deduction, a lot less folks are itemizing. I mean, the big deductions around home ownership are that mortgage interest and the property taxes, which everybody hears about, the state and local tax cap of $10,000, which impacts a lot of families here on the island. You know, it crushes us because most people are having close to $10,000 just in state income taxes taken out of their pay. So they're not necessarily getting to deduct all those property tax on a federal level. State level is a different matter. A lot of folks can itemize for the state, but not for the feds because of that they call SALT cap that you'll hear about. And it depends on when in the year you purchased the home. If you purchased the home in November, December, you're not going to have paid a lot of that mortgage interest. It's going to be more of a benefit for you in the subsequent year where you're making those 12 monthly payments. If you buy the house mid-year, it's not as beneficial as it is to have that house as a write-off for the entire year.
Now, let's talk about at the closing table. There is various expenses that the buyer may have at the closing table. Prepaid interest, which is starting to come back in vogue, legal fees, title fees, things of this nature. What of these fees, if any, are deductible within that year?
The big one is the points on a first mortgage. You know, those you can write off. And if you're paying any MIP premiums, you can write those off too. Mortgage insurance premiums are going to come on that Form 1098 from your bank. If you are forced into escrow, sometimes if you're taking some of these FHA loans, they'll force you to have that MIP on there. It's a separate box on that Form 1098. you'll see it, mortgage insurance premiums, and those are deductible also, depending on your personal situation. Sometimes if your income is too high, you don't get to take that MIP even though you're paying it.
Now, I just want to backtrack one quick second, because you did talk about the property tax being deductible on a state level. Mm-hmm. And at a typical closing, even though the closing may happen in, let's say, November, because of the way tax adjustments are done between the sides, that buyer may have still paid
some of those taxes, which will be deductible.
Correct.
Which is why if you've purchased a house, when you sit with your tax professional, bring that closing statement, always.
Excellent advice. I tell that to clients all the time. Not sure they always listen, but maybe they'll listen to you.
With my clients, if they've purchased or sold, I always say, bring that closing statement. And if they've sold the home that they bought, bring that closing statement and bring the one from the purchase in case there's anything there that we can take.
Absolutely. You know what? My feeling is the same thing when I have clients and we're dealing with a real estate transaction. Bring me all your paperwork. It's a lot easier to bring me in a stack of paperwork and I tell you we don't need it than to be the other way around.
Absolutely.
So, okay. So other than, now what about legal fees? Are legal fees deductible when somebody purchases?
No, unfortunately.
Okay.
Unfortunately. Especially you being a lawyer, you'd love it to be a write-off for them.
It's certainly.
Then you could charge them 30% more and it cost them the same.
And tell them it'd be the same, exactly. Okay. All right. So other than the points and the like I said, the mortgage insurance that we said
and
on
the real estate adjustment, the real estate tax adjustments, those are going to be the big ones.
Okay. Excellent. Okay. Now let's swap over to the seller side. Mm-hmm. Seller gets a little bit more confusing, and there's two things with sellers, and I'm going to kind of jump a little bit. Sellers always, almost all my sellers always start with wondering about capital gains. Mm-hmm. Now, capital gains is a subject that we can spend an entire show on, and we will. Yeah. But just because I don't want to neglect it as a topic. So, just as a general overview, when the seller's dealing with or concerned about capital gains, what are they?
Well, you paid X dollars for the house when you purchased it 10, 15 years ago, and you're selling it for a price today. The capital gain would be the difference between those two. But what a lot of people don't realize is you've also put money into that house over the time you've been in there. You've put a new roof on. You've put a new driveway down. Keep track of those large capital expenditures because that goes into what's your accumulated cost basis in the property, which is what you paid for it plus any improvements that you did during your time of ownership. Then the difference between what you sell it for and that cost basis is what you're going to pay capital gains on, depending on how large the gain is. If you're married filing a joint return and the house has been your primary residence for 2 out of the last 5 years, you can walk away from $500,000 worth of gain. You don't see a ton of homes in our area going with more than $500,000 gain. But, $250,000, $300,000, somebody bought a house for $100 and sold it for $5 is not uncommon. But that $100, they've put $100,000 in over the time they've lived there. They've put an addition on, roof, driveway. Keep track of those major expenses. Just keep that in your permanent records. Keep a little in the file cabinet at home improvements. And there are other things that those home improvements, there are tax credits also that we could talk about. I always talk about this with my clients. There are tax credits for making your home more energy efficient. New central air, boiler, hot water heater, insulation, exterior doors and windows that a lot of folks don't talk about. The big one everybody likes to talk about is solar because that's the one that's most publicized. It's 30% credit for solar. A lot of these other ones are a couple $100 here and there, but better in the taxpayer's pocket than the government's.
And again, like I said, I don't want to get too into the weeds on capital gains because it is a subject that we'll cover in a later episode. If I don't traumatize you too much and you're willing to come
There's
back.
all different issues you could talk about basis. Did they buy the house? Did they inherit the house? But that's digging way down deep in the weeds.
Sure, absolutely. And whether it's a primary and not a primary.
Primary versus a rental property.
So now let's go back to leave capital gains. We're still dealing with the seller. The seller has expenses at the closing table. Again, legal fees. There are, broker fees.
The biggest one is the broker's commissions, usually, running 5-6%.
Sure. Now, are those deductible?
Yes.
Okay.
Those come off your selling price when you're computing that gain.
And what about legal fees? Any other?
Yep, legal fees are deductible there. That all gets rolled up in.
So legal fees are deductible for the seller, not for the purchaser.
Correct, yeah.
Okay. Seems a little
They kind of get rolled up into the basis for the purchaser. So you'd include that in your cost because you laid it out at the table, but you don't get to write it off immediately. You don't get a write-off for it per se at the closing table, but it comes off your selling price.
So it's a credit for capital gains? Are we?
Well, it's coming off your net sale price.
Okay.
So you sold the house for $600,000. You've got $30,000 worth of broker commissions, other closing fees, including the attorney. That's all going to come to give you some number below 570 in this case.
Okay.
You know.
Okay. So when it comes to their actual personal tax return that they're filing for that year, they're not actually writing off those fees then?
No, it doesn't show as a write-off. It shows as a reduction in your selling price.
Interesting. Okay. So it may have an effect or it may not have an effect on the taxes at the end of the year then?
Well, if they're using that exclusion, it's not going to matter.
It's not going to matter.
If they're over the exclusion, it's going to matter.
Then it matters. Interesting.
Yeah.
Okay. Dealing with, let's backtrack to, our purchaser.
Sure.
If a purchaser is now dealing with their loan officer, their attorney, and they're formulating a deal, is there anything that you could suggest that they could do in that formulation of the transaction that would increase or give them more deductions? Or are they pretty much limited to what we discussed?
You're pretty much limited to what we discussed there.
Okay.
But whenever you're doing any major financial transaction, talk to your accountant, talk to your lawyer. So talk to the appropriate professionals. It's a lot easier to get it done beforehand than to clean up the mess after.
Okay. So, and then as for a purchaser, other than moving more money towards prepaid interest, paying down, those points that we discussed, that's really about the only thing that would impact
that would help.
return.
Yeah, and if you can avoid the PMI, depending on how much money you put down, but that's more a discussion for the real estate attorneys.
Sure,
how much
the loan officers,
and the loan officers and the mortgage folks.
Yeah. Yeah, it does get confusing because you change one variable and everything else changes.
All the numbers change. All the numbers change.
So, now what about a seller? What other expenses or what other things can a seller necessarily wrap into their transaction? I'm thinking things like, for example, if they had to make repairs within that year before.
Those would get rolled up into that cost basis.
Okay.
All those repairs, you roll those up into your cost basis, and this way you're reducing what you're paying gain on.
Okay. So there's really not a lot that they can do that becomes like an itemized deduction, if we can use that phrase.
No, the only itemized deductions around real estate is mortgage interest and property taxes.
Okay. Interesting.
For 99% of the folks.
Okay. All right.
And a lot of folks don't talk about the tax credits for doing the home improvement. That's the other real estate-based thing that people can do.
I'm actually going to come back to that subject in a little bit because the tax credits are one that I think doesn't get enough discussion, even to myself. I mean, if you would ask me before, having you on as a guest, I would just say everything you did to a house is a capital improvement. It affects your basis, so keep receipts. Yeah. But hadn't really thought about how those interplay in terms of on a bigger picture.
Not a lot of people talk about it, which, competitive advantage.
Yeah, absolutely.
Hopefully my competitors aren't watching this.
So,
for your sake, hopefully they are, but I don't need to tell them all the trade secrets.
Okay. So now there's one other group. We've talked about buyers and sellers. And the other group that I want to talk about are existing homeowners that do either a refinance or a HELOC. There's another subset, which would be a group that does reverse mortgages. But let's keep it simple right now and deal with somebody who either does a straight-out refinance and replaces their existing loan or adds a second one, or as a HELOC, which is basically a line of credit. How are they basically similar to a purchaser? Anything unique?
They're similar. If you're using it for things other than the home itself, if you're doing cash out and using that money for something else, there are interest tracing rules that if they audit you, they'll go, all right, this isn't all necessarily primary home interest. You took this out to pay for your kid's college. If they trace some of the proceeds on that, you can have some issues.
And that's an interesting subject because that's also a phrase I haven't heard before. So let's
the interest tracing rules.
So explain a little bit about what that is.
They dig down and say, okay, we took this extra money out of the house. Did we use it to consolidate debt? And everything is still secured by the home? Are we buying cars with that extra money? Are we paying for a kid's college? What are we doing with the extra money? And they'll actually trace that if they look at you. Okay,
so in other words, just the fact that the house is the collateral on the loan is not necessarily...
doesn't necessarily perfect the itemized deduction for interest. And one of the other things around interest is if the mortgage is too large, you don't necessarily get to write it all off.
Okay, explain that one a little more.
You used to be, if you had a mortgage, it used to be unlimited. You could have a $3 or $4 million mortgage, it would all be deductible. And they grandfathered certain rules in depending on when you took the mortgage out. Now they cap it at about $750,000. If you're buying a new home or an existing home and your mortgage is larger than $750,000, you may not get to write off all that interest on that. They cap it at $750,000 with the Tax Reform Act of 17.
Interesting.
I run that on a couple of clients where they've got mortgages over that amount, and you have to go through a couple of extra computations to see how much of the mortgage interest is actually deductible.
Interesting, because I know the FHA also increased, the limit on what they'll do, which is actually higher than that cap. So that's
so it's going to be interesting doing those returns.
Yeah, especially for people who now no longer had to go for a jumbo or non-conforming loan for that $1 million loan, and then find out that they're not getting the deduction that everybody else is.
They can't write off all the mortgage interest. They think, all right, I've got a $2 million mortgage at 6%. I can write off $120,000. No,
not going to happen.
It's going to be limited.
Interesting.
And a lot of folks that are trying to do the self-help. I've got a simple return. I've got a W-2, and I've got my mortgage interest, and I'm going to try and do it on one of these tax packages that advertises during the Super Bowl, or go to one of these fast food tax prep places. They don't necessarily know that rule. And we catch it, because it's better that we catch it and do it right than that you get a love letter 2 or 3 years down the road from a taxing agency saying, you over-deducted your mortgage interest. Please give us a little interest and penalty on that.
Yeah, and again, from my tax practice, I can say that by the time you get that letter, and it's 2 or 3 years down the road, you're already under the hole, because you've got penalties and interest have been accruing.
And then if they look at 1 year, you probably did it wrong the second year and the third year.
Yeah, and it all snowballs.
We see that a lot with the folks that try and do it yourself.
Well, one of the things I always say with a lot of professions, law, accounting, and medicine, it's as much art as it is science. And it's not just knowing rules and knowing code and being able to quote things back. There's
knowing what they look for.
Yeah.
Knowing what they look for, knowing how to present it appropriately. We're doing this for 36 years. We've been blessed with not too many audits over the years, Now,
real quick, last category that I want to bring up is the reverse mortgage. Mm-hmm. So you have your senior who wants to stay in their house. They do a reverse mortgage. How does a reverse mortgage affect, if it does, their personal tax return?
We haven't seen too many of those.
Okay.
I haven't seen too many. I think I had one client do one, so
okay.
Don't have a lot of experience in that area. I think I've seen one in 35 or 36 years. You're not seeing a lot of people doing it.
No. I mean, on Long Island, it's kind of strange, too, because I think a lot of people just sell the house and look to downsize.
You're seeing a lot of that, a lot of selling and downsizing. Real estate market has been crazy the last couple of years. Slowing down a little bit with the increase in rates, but rates have started to come back. So my realtor clients have said they're starting to see it pick up again. Yeah.
And it's interesting. So now I want to circle back. You brought up the subject of tax credits. Mm-hmm. And, we gave the definition in a couple of examples, but I think for most people, lay people who aren't in the profession, the more examples they have, I think the better. So let's, again, a tax credit, you said solar, getting a more efficient water heater, more efficient boiler for your house.
Yeah, these are all things where you're making energy efficiency improvements to the home. There are tax credits available that a lot of people don't realize.
Because basically almost anything you replace now, that's a 10-year-old appliance, if it's a washing machine, a dishwasher, a washing machine, refrigerator, is almost guaranteed to be more efficient than the one that was in there existing.
Correct.
Will those things count as well?
No, it's more on the things that help the entire house become more energy efficient. The exterior windows is a big one. Exterior doors is a big one. Boiler, hot water heater, central air systems.
So we're talking larger systems, not necessarily. For example, if you went with a toilet that used half the water, that's probably not going to count.
No.
But if you replace, again, something big, a boiler.
I mean, some of the other appliances, there may be some credits and things available through your utility company, but they're not going to show up on your tax return.
Right. So again, if in doubt, the advice to a lay person, anything that you might have replaced in the last year, tell the person who's preparing your taxes.
Pick up the phone, exactly.
Let them be the one to say it doesn't count.
And use it as a brain jogger if you've done anything in the last 2 or 3 years and you didn't tell your preparer, it may or may not be enough money to go back and amend and get that credit.
That's interesting. So you're right. So, for example, if it was only to say, get you $100, it's not worth doing it.
It's not worth paying the guy to prepare it. But if it's $5, it might be.
Sure. And if you did a couple of big systems, like let's say if you did a boiler and a water heater,
you could get up to $1,000. If it's going to cost you a couple $100 to get an amendment, it might make sense.
It may still be perfect.
You sit down and have an educated discussion with your preparer. They'll know if there's any other gray areas on the return that might expose you. Because when you amend, you're open for another 3 years for them to come look at you.
Gotcha. So like always, you got it to balance.
If you're a W-2 guy, it may make sense to amend. If you're self-employed with a business, which is where they're focusing more of their efforts, it may not make sense to amend.
Gotcha.
You got to look at your overall risk pattern and
Sure.
talk to your preparer about that.
Interesting. But again, that's the whole key, knowing what questions to ask so that, your tax preparer, but again, not that they're trying to purposely not do their job, but things get missed. If a client doesn't tell the tax preparer about something, they may not know about it.
Oh, exactly. Fixing other preparers' errors. We had one where the family was using the same preparer for about 15 years. And the first year I reviewed the return, I asked him who one of his dependents was. And he said, oh, well, she used to be my girlfriend. Now she's my wife. So he'd been filing under the wrong status for the last 7 years. Something simple like that. Now, we couldn't go back and amend 7 years for the gentleman, but we went back and amended 3 years and got him back $25,000, $30,000 because he was a high-income individual by changing his status.
Sure.
He had gotten into that comfortable pattern of just dropping stuff in his preparer's box without having a 10-minute conversation to say, what's new in your life?
Yeah.
You always have to do that. Have that 10-minute conversation, even if it's not a half-hour sit-down. 10, 15 minutes. What's new and different? What did we do to the house? We're thinking of selling and moving someplace. What are the consequences of that going to be?
Yeah, no, that is it. And one of the pieces of advice that I tend to give clients, and I think is appropriate here, is one that I was actually told when I was studying for the bar and getting ready for the exam. And I was told, dismiss it on paper, not in your head. And it's very similar here. Don't make the assumption on your part that it's not deductible or not important. Tell it to your tax preparer, tell it to your professional, let them tell you it doesn't apply. That's probably the best advice we can.
Yeah, there is no such thing as a stupid question around taxes. We'd rather you ask 10 questions and get it done right than miss a write-off or credit that you're entitled to. We never want to leave any extra money on the table that's you're entitled to.
Yeah, that's it. Dave, I want to thank you so much for being here. This was certainly eye-opening for me. The whole thing about with the tax credits and some of the other was new to me. And some of the areas that I didn't know as well as I thought I did. So I want to appreciate you for educating me, and thank you for, I'm sure, educating everybody else as well. Dave's contact information is going to appear at the end of the program. I know he's available in Islandia, and Dave will tell you himself, if I stop talking, that you can always reach out to his office. He'll be happy to answer any questions, any inquiries that you may have. And as he said, he's more than willing to talk to you about looking back at some of your past returns and seeing if there's money that was left on the table for you. Dave, thank you again for being here today. And again, if you bought a house, sold a house in the last year, or did a refinance, you may want to have that conversation with your tax preparer. Let them know what you did. Bring them that closing statement for any real estate transaction you did in this year. If you refinanced, did a home equity or reverse mortgage, same thing. Don't make any assumptions. Let the professional tell you what counts and what doesn't count. Again, Dave, thank you for being here.
No, thanks for having me.
Dave Korcz, PC, they're in Islandia. Again, their contact information will be at the end. My name is Joseph Beige. I'm a real estate attorney located in Smithtown. And as always, thank you for watching. If you like the program, again, please hit the like button. Let Google know that this was a program worth viewing. Thank you.